Happy Monday out there, Team 42. It's your skipper, Darius Dale, here to present our macro minute for Monday, November 28th, 2022. It's great to be back on the grind after a nice week off in vacay. Starting with our economic release spotlight. So, very light spate of economic releases over the past 72 hours. So, we thought it'd be a little bit more appropriate to focus on the week ahead. It's a massive week ahead as it relates to economic data in terms of different catalysts from a macro catalyst perspective. And we ultimately think this is likely to be the week where sort of the bullish flows dynamics that have underpinned asset markets really quote Q4 to date are likely to start to transition to bearish, back towards bearish macro dynamics, and we think some of these catalysts might be the trigger, or at least partial trigger to that process. So let me just go down and highlight some of the key catalysts that we see this week, organized by macro cycle, starting with the growth cycle. So I'll be quick because there's literally probably 30 or 40 different things that are very important here. I'll highlight the most important ones from each category. So on the growth cycle, Wednesday we get China's PMI data. That should be bearish. Wednesday we get the U.S. JOLTS data as well. That's going to continue to, in all likelihood, continue to support our view that the labor market is still way too tight for the Fed to do anything but other than continue to tighten. Thursday we get personal income and personal spending. Likely to continue to support our view that the U.S. consumer is likely to remain resilient. That's not good for asset markets from a liquidity cycle perspective. And then Thursday, we get initial jobless claims. Friday, we get the jobs report. And Thursday, we get the manufacturing PMI as well. From an inflation cycle perspective, Wednesday, we get the EIA crude oil inventory report. Thursday, we get U.S. PCE inflation. Again, PCE, as it relates to inflation, doesn't have the same wonky medical insurance sort of index dynamics that we saw in the October CPI report on the 10th of November. So we'll see what inflation likely really is, absent those wonkier dynamics. And then tons of liquidity cycle updates this week. So Monday we get New York Fed President John Williams. He's been leaning sort of kind of more hawkish, center right, if you think about dovish to hawkish as a spectrum. Jim Bullard's been very far right in terms of being a hawk. We get ECB Christine Lagarde, she's center right as well. Fed Chair Jerome Powell is about as hawkish as any central banker on the planet. That's on Wednesday. We also have a bunch of other Fed speakers on Wednesday, including Michelle Bowman, Lisa Cook, likely to be on the more dovish side of things. Wednesday we get the Fed's Beige Book. Thursday we get Dallas Fed President Lori Logan. She's been a center right hawk as well. Michelle Bowman, Michael Barr, center left. BOJ Governor Kuroda is going to continue to triple down on yield curve control, which is likely to be very supportive for the dollar at the margin. Friday, we get Chicago Fed President Charles Evans. Certainly has been a center left dove, has actually gotten a little bit more dovish in recent speeches. And then lastly, again, we get on Friday, we get ECB President Christine Lagarde, who's likely to reiterate the fact that the ECB needs to continue hammering home this inflation fighting battle. So again, as I mentioned, huge week of economic and policy updates. Definitely think a lot of the flows that we saw support asset markets that we called out in the end of September likely start to fizzle out here and really give way to some more bearish net liquidity dynamics here in the month, or not here in the month of December, but soon to be the month of December. Anyway, transitioning to my Longbow dashboard, going down, starting with global macro. I guess starting with the dollar index, so that's bearish from a short-term and medium-term price momentum perspective, in the middle of the range there. Let's just give it a look at the dollar. I haven't seen the dollar chart in a while on this program. So, starting to get towards the lower boundary of the range there. Unlikely to see a significant recovery back to the previous highs of the trend, just given kind of the breakdown in momentum and the unwind a lot of the sort of CTA type positioning associated with the dollar there. But certainly could see the dollar kind of recover really into December or into the end of December and really into the early part of next year. If we are right, you have to be right on, one, to make money in financial markets, you got to put the position on. Two, you got to be right on the damn position. And so if we are right on our views in terms of the sticky and stochastic nature of the disinflation process and how that's likely to coincide with a pretty sharp reduction in net liquidity over the next 6 to 8 weeks, it's very likely we see the dollar at the bare minimum kind of formulate a lower high relative to the previous highs that we saw. So just be on the lookout of that. Gold, bullish from both the short-term and medium-term price momentum perspective, in the middle of the range. 10-year Treasury yield bearish from a short-term momentum perspective, bullish from a medium-term perspective, also in the middle of the range. S&P 500, that is bullish and from both the short-term and medium-term signaling perspective, in the middle of the range. VIX, that is bearish from both the short-term and medium-term perspective in the middle of the range here. The range on the downside of the range has 1898 handle. I don't trust that as much as I don't really trust that in the context of us being in the bear market. Typically in bear markets, and our friend Jim Carson over at Kai Volatility Advisors talked about this as well, but traditionally in bear markets, 20 is right around the lows as you're going to see in the VIX. So unless we're heading into a new bull market, it's very unlikely that we see a significant breakdown below 20 in terms of kind of at the money implied vols for the S&P. NASDAQ 100, that is bullish from a term momentum perspective, neutral from a medium term perspective in the middle of its range. Russell 2000, that's bullish on both durations in the middle of its respective range. Bitcoin, Ethereum, same story, bearish for both durations in the middle of their respective ranges. Shanghai Composite, that's bullish from a short-term perspective, bearish from a medium-term momentum signaling perspective. Let's see the Shanghai Composite. So the range has gotten quite narrow in recent weeks as we've sort of seen a lot of volatility dissipate at those big protests in China. Or not big, they're medium-sized protests in China. They were small, kind of scattered about throughout the year. Now they're starting to get a little bit bigger as the citizens of China are getting quite discontented with zero COVID, amongst other things. But again, this is an authoritarian regime. You got a guy who's in control of the military, the Communist Party, the economy, et cetera, et cetera, et cetera. It's very likely that we see pretty significant heavy-handed crackdown. China is not a place where political dissidence is rewarded by policymakers. It tends to be quashed, and unfortunately, going back to China's pretty checkered history, Tiananmen Square to be example, tends to get squashed pretty aggressively. So we would expect to see that in this scenario as well. And then lastly, crude oil, bearish from a short-term momentum perspective, bullish or bearish from a medium-term perspective as well in terms of momentum, and then really in free fall. So the market has really kind of eviscerated the geopolitical risk premium out of the energy markets. You're now starting to see a little bit of unwind of that backwardation that we've seen that's been a feature of the crude oil prices rally as well. And now we basically wiped out the entire 2022 run in crude oil prices. Now we're at the lowest levels that we haven't seen since last December. So, this has been something that's been quite supportive for headline inflation. But again, as we talked about many times in this program since dating back to the summer when everyone was focused on crude oil back then, we said, hey, look, it's about services inflation. And increasingly, it's going to be about services inflation, less rent of shelter, because we all know that the rent of shelter dynamic is lagging and it's going to continue to accelerate at least through the early part of Q1. Anyway, getting to my free daily alpha tab here, where we sort, sort of all the different. We have 300 ETFs here, all representing individual factor exposures across global macro. We sort it by the odds column to give an indication of what's most overbought to see if you can help you try to make some actionable trades today. Nothing's really signaling true overbought. New Zealand soybeans kind of getting there, but not quite signaling anything that you should be actionable about. But we are TBX, so bullish TBX. So this is the inverse of the 7 to 10 year treasuries. So this has obviously been a phenomenal trade for those CTAs, et cetera, this year. That is now starting to signal oversold here, bullish from both the short-term and short-term price momentum perspective and medium-term momentum perspective as well. So this is something you want to be thinking about shorting, kind of 7 to 10 year treasuries this morning as well. I would imagine we'll probably see some other treasury type exposure as well. So with that, Darius Dale presenting our macro minute for Monday, November 28th, 2022. Best of luck out there. It's great to be back. Looking forward to another fantastic week. Got our macro scouting report for the month of December on Friday. So looking forward to putting that together for you guys and going over the unpacking all the data with our clients. So thanks for tuning in. We'll catch you back here tomorrow. Cheers.